Welcome to Season 3 of the Knack for Business podcast. Over 300 episodes strong, we're here to ignite your entrepreneurial spirit with fresh insights, networking gems, and creative strategies that elevate your game. Are you ready to discover what your Knack for Business truly is? Your hosts are Bernie Franz-Grote from Creative Insight and Wayne Pratt from Motivate You, Inc.
Today's topic is Stop the Bleeding, Transform Financial Confusion into Clarity. Question for the audience. Why does your business look profitable on paper, but you're struggling to keep cash in the bank? That's what our guest is all about today. Our guest is Matt Partrich from Gains Capital Books. And Matt is the founder of Gains Capital Books, a fractional CFO firm dedicated to helping small businesses, e-commerce brands, and service providers achieve financial clarity and maximize profitability. With over 20 years of experience, Matt specializes in cash flow management, profit optimization, and financial forecasting, using data-driven insights to turn financial chaos into clarity. He's worked across industries to help business owners make informed financial decisions, eliminate cash flow uncertainty, and drive sustainable growth. But when he's not diving into the numbers, you'll likely find him exploring national parks or planning his next hiking adventure, because for Matt, finance and adventure go hand in hand. And you know what, Matt? Welcome. Good to see you again and good to hear you again. What is your favorite quote or saying, sir?
Good to see you as well. My favorite quote is, "A business that doesn't make money is just a hobby." That's from Warren Buffett.
And does your business have a tagline that you work with?
Yeah, we're working with financial clarity for smarter business growth.
Small businesses, people starting up, what are the typical things that go, hey, you shouldn't have done that, buddy? What do you see happening out there?
One of the most common financial mistakes that small business owners are making is they're just not keeping track of their cash flow. They might be generating revenue, but they're not managing their cash flow effectively. They can quickly find themselves in a difficult financial situation. Another common mistake is not having a clear understanding of their financial reports, such as a balance sheet, income statement, cash flow statement. This can make it difficult for them to make informed decisions about their business.
What are the biggest signs that you're hemorrhaging your funds without the owner noticing? What are the telltale signs?
The easiest one to tell is when you're just not able to meet your financial obligations. If you're struggling to pay your bills on time or you're consistently running out of cash, it's a sign something's wrong. Another sign is the business is not generating enough revenue to cover its cost. If it's not profitable, it's going to struggle to survive in the long term.
The difference between profitability and cash flow is one of the core differences that people don't understand about finance. Is that more fair?
Yeah, it can be very fair because you can have a profitable business, but if you're not running healthy cash flow, then it's a constant struggle. You can have profit month to month, but if your cash flow timing is not well, then you're constantly borrowing money or trying to rob Peter to pay Paul just to stay alive. And that's no fun for anybody.
One of the things I experienced when I first in the business venture, I was very fortunate. It was inside a corporate structure and they had a side business running within the space. And the VP of finance one time came up to me and says, Bernie, how are you managing your books? And there was an accountant involved in it, et cetera. So it wasn't a mystery box at the end of the month or a year. But he said, how are you looking at your finances? How are you doing? Are you doing the accrual basis versus what is the balance in the bank account today? And what are the differences? Because I'd imagine most people go, the simple thing is, oh, the gas tank's half full. And if you're doing a 2,000-mile journey or a 2,000-kilometer journey, no, you got to map a bit more out. Can you walk us through the concepts?
So talking about the difference between cash and accrual accounting? Cash, and I find most CPAs I work with to work in the cash basis for tax purposes, because that's really about what's happening today and where the cash is, where the cash goes. But the accrual basis accounting is more of a realistic view of the business and the action that's taking place. For example, we do things with prepaid expenses. Insurance is a great example of that. You pay your insurance maybe once a year, once every 6 months, but you're getting that service over the next 6 to 12 months, depending on how that is set up. So instead of just looking at that as a one-time expense for that month, you spread that over the course of time so that you get this more even flow and realistic look at what you're spending. in the business itself. Now that's in the cash basis, that would be a one-time hit. But in an accrual basis, that is really looking at it as the reality of that situation. And we look at it in the opposite direction too, with things like unearned revenue. So if you sell an annual subscription to someone and take in a bunch of cash now, it looks great on your cash books, but you really have created a liability going forward that you owe this client that amount of work that they've paid for the rest of the year. So we have to track that and know that if you were to shut the business down today, you actually still have a liability out there and you do owe for those services.
It reminded me of an instance where someone did not pay attention and they got membership fees for the year and they were winding down and they were going, but the money's already gone. That's the wrong answer.
Exactly.
Matt, you talk about working smarter, not harder. What does that mean to you?
Utilizing whatever tools that you can is very important to me. I know we live in an age where AI is coming into play, and there's a lot of talk about that. And realizing that any business owner can leverage things that maybe we're not great at by using tools or delegating those tasks to someone else. A personal example, I'm terrible at marketing. It's not in my blood. I'm a numbers guy. I like to be in spreadsheets. So to realize that's something I need to outsource is very important to me because it takes a lot of time, a lot of energy, and it's something that I don't enjoy doing. And it's not why I got into business. So that's a thing that I can outsource. Things like writing posts. We can use AI now for things like that. I know that's maybe not the most popular opinion, but times are changing and we have to move with them.
So what are the biggest cash flow killers that small business owners overlook?
One of the biggest cash flow killers for small business owners is typically poor invoicing and payment terms. If you're not invoicing your customers properly or you're not following up on outstanding payments, it can lead to significant delays in receiving your payments. This causes cash flow problems, especially if the business is not generating enough revenue to cover its cost.
What are good terms for a business? Is it dependent on the type of business? If you're a garage versus a software as a service provider versus other types?
Yeah, it definitely depends on the business. If you're, for example, a business like mine, we take our payments up front because we're not going to go to the end of a month having done all this work and then run the risk of not getting paid. But for example, maybe a manufacturing position, they're going to go on the line and run their credit or however they're expensing their development costs, then say net 30, net 60, net 90, depending on who their clients are and who their vendors are, and churning the cash flow in a way that's going to be consistent with their costs are and what their clients are and what their clients need.
Matt, can you share an example of a business that looked really good on paper, was actually deeply in trouble?
Yeah, I have a couple of those at the moment. I won't name any names, but I've got a great one right now. It's an incredible business. Everything they're doing is right, but they've fallen into a debt trap. It starts with trying to go after credit card reward points, which as long as you're not paying interest, you're winning. But the second you start paying interest to them, you're losing. And now that you're having to carry a balance, now you're trying to catch up. And as you continue down that path, you can get into more debt. And a big portion of what you're doing is just paying banks for the privilege of borrowing money. I'm dealing with a couple of clients right now where we're digging out of debt holes and building our working capital to a point where we're not having to chase the debt constantly.
I found a lot of entrepreneurs all have E.
What are you talking about?
So can you tell me what reports aren't optional? What do you actually have to focus on?
Three main ones: income statement, balance sheet, cash flow statement. The interesting thing I see a lot of times is that a lot of owners I meet with or take over their financial management, they've been through bookkeeping, CEOs, CFOs that never show them a cash flow statement, which I find bizarre because that's incredibly important. Most of them have seen a P&L, or income statement as it should be properly called, a balance sheet. They're familiar with those most of the time. But the second we put a cash flow statement in front of them, they're blown away. What is this? It's vitally important for every business to know those three statements, if nothing else.
And why do you think clients aren't asking for these?
They just don't know. Depending on the level of your business and how you work, if you're a startup with very little revenue or in that medium range where you're growing and the books are getting out of your control, you may not have had professional encounters with these statements. You may not know what they're really telling you. It's important at a certain point in your life cycle of the business to get in front of people who do know, and to get in front of people who know how to look at those statements and really read them and understand what those statements are telling you.
Inside a cash flow statement, what are you looking for? What are the, without actually getting down into line 14, look at this. But if you've never seen a car before, if you've never seen an elephant before, how do you know you got a good elephant? Like an elephant.
Yeah, the easiest thing with the cash flow statement is the movement. So in a cash flow statement, what you can focus on is the line item of the change in value from period to period. Did you gain cash? Did you lose cash from last month to this month, last quarter to this quarter, last year to this year? Those are the things that make you want to take a look and go, I may show profit on my income statement, but cash is flowing out of my business, and that's just not sustainable.
Up here, I find one of the biggest problems I see is they don't really understand that sales tax and income tax isn't their money. So they live on the gross instead of the net. And then after a $200,000 a year, they're bankrupt. Do you see that happen?
Yeah, we do. I tend to really like to push my clients into sort of a profit first model, if they're familiar with that system. There's a specific bank I like to use. I think they are based in Canada, but I'm not going to call them out because they're not paying us here to talk about them. They have a system where as the money flows in, it can be redirected to specific accounts. And I really love to use that system because the second the money comes in, it goes into your sales tax account, your income tax account, your profit account, your owner's compensation account, your operating expenses accounts. And that just makes it so simple for a business owner to know what is their money and what is not their money, and know what is the business's money and what is the government's money. And to really not start digging into those liabilities that they have coming up.
I think render unto Caesar what is owed to Caesar is a really important item, because Caesar gets really ticked off with you otherwise. In my career, and everything came into one account, and they kept divvying up the money. So X comes in, goes over here, right? So you understand that. But if you have a good bookkeeper, it shouldn't matter. There's one central account. You might have a secondary account if you're having reserve funds holding back cash, so that be optimized to generate more interest work for you, or whatever the vehicle is. If you have a bookkeeper, does software not help you sort that out as it comes in and says, bill goes out, so much belongs to the tax man? If there's labor involved, that breaks it down, and taxes or benefits that are owed to the government for staff, workman's compensation, the usual stuff, right? Employment insurance. Does that not all that, hey, break it out and say, so much goes here, you might have it sitting in the bank account, just don't dip into the bank account? Is that not how it's supposed to be? Is that how it works when they're working with you, for example, and doing books?
The best bookkeeper in the world cannot solve owner impulses.
Shock therapy there.
And even as a CFO, I can sit with clients and explain what they need to do and advise them on certain paths, but I don't have control over whether they listen to me or not. People have different emotional reactions to money. People have different psychological history with money, and therefore they can have different reactions to seeing money in their bank account and just think, oh yeah, I can just go spend this. For most clients, I find that separation of taking money and setting it in accounts that say, hey, don't touch this because this does not belong to you, can be helpful. It's not without flaw. because there is a human element to these things, especially in the solo entrepreneur or solopreneur or the small business person who's really got themselves involved in their business in an emotional way. Commingling of funds is one of the hardest things for us to deal with. And it's one of the biggest fights I have with clients all the time. You, Mr. Client, are not you, Mr. Client's business. And we have to make sure that we have a very specific line separating the two of you. And you have to have this understanding that what's not your money is not your money.
Is that, I don't know about down there, but up here, that can actually lead to jail time.
I don't know that it's actually a jail time thing, but it is a real red flag for the IRS and can end you up in an audit, and that can end badly. I don't want to sit for any audits. So that's one of my big arguments with clients is, hey, don't do this because I don't want to have to go to court with you.
It's interesting. I talked to an accountant up here, and he mentions that you're making a kind of a daft mistake. If you have even staffing, right? If you say they're contract and they're not, or they're functioning more like staff, the Canada Revenue Agency looks at it. If someone calls in and says, listen, I need my benefits, they'll look over and it's like the eye of Sauron, you're stolen. And next thing it's like, you're getting a notification, and that notification means, yeah, we're assuming that was a staff member and you didn't pay us, and not so good for you.
I haven't run into that here in the U.S. Typically, there's a pretty solid delineation between a 1099 and a W-2 employee. W-2 being your standard employee that's your typical thought of an employee of a business where they get a paycheck, tax withholding, and benefits, things of that nature. But a 1099 is pretty clear that, hey, you're on your own and you're just a contractor for us. And the person who is the 1099 should really be looking into their own, whether it's Schedule C type business structure, handling their taxes on their own. The business paying them is saying, we don't want anything to do with your taxes, you deal with it.
That makes sense.
How do you know if you're undercharging for your services? You think you're doing fantastic, but you're not making any money.
Oh, the biggest sign is if you're not covering your costs. That's a pretty straightforward thing that would tell you you're undercharging. One of those things you should do in that area is to just research your competition, understanding what they're charging for their products. And are you in line with that? Or is there a reason that you should be adjusting your pricing? Or do you have a problem in your costs? What are your costs of those goods sold, or your cost to generate whatever service you're offering or product you're offering? I completely lost track. I'm so sorry. My dog's back here whining.
It's Wayne's dog.
No, what's your dog's name, Matt?
That one's Ripley. I have one named Nutmeg and a cat named Diego.
Love the name.
Sorry about that. Did I blow that question up?
If I was in the bookkeeping business and I had pets, I'd have debit and credit.
That's a great. There you go. That's our good names. You never know which applies to which category.
It's a problem.
Depends if you're chasing one. It's a credit to your exercise, but it's a debit to your time.
That's great. Now I got to go get 2 more pets.
How do you help a client realize that if they sold less at a bigger profit, they'd actually wear themselves out less and make more money?
It's a great question, because you often run into clients their solution for everything is generate more revenue. That's, if things are going wrong in the business, generate more revenue. That's not always the correct answer. We have to look at things like your expenses. Are you paying for 12 pieces of software that all do the same thing? Is your marketing budget through the roof? One of the big things I've come into with a few clients is that they keep trying to generate more revenue by spending more on marketing, but their marketing's not returning the appropriate amount. So they're actually losing money in the process. So we have to look at that and say, if you were to actually sell less at a 5% increase in your price and reduce your marketing by 20%, if you're that high, let's say you could reduce your marketing by 10% and sell at 5% increase. Looking at the numbers, we can figure out ways that bottom line increases. It's just about getting everything in balance, working with benchmarking. you can benchmark against competitors and say, what are these people spending in market? What's the average for your industry? What percentage of their gross revenue is their marketing budget? What percentage of their gross revenue is their labor, the contract labor, their employment? What percentage of their gross revenue is their personal compensation, the owner's compensation, and so on and so forth, until we get into you can look down an income statement and really quickly point out, hey, you're way out of line here. We need to rein this line item back in.
One thing I learned from doing budgets in the past is when you plan for the upcoming year based on what the actuals are in this year. So you get a sense of tempo. If something's not working well because people aren't buying into the service and not utilizing it, you reduce it or you change the offering to make it more viable. Would you say, though, building out a budget to start off with would help? So you have a roadmap, a baseline that you think you should be at, working with a professional saying, this makes sense. Because I might say, I'm going to only pay the government 2% this year. If you have more revenue, that's going to adjust. And that's not a line item that you're going to budget for. It's based on how much you're charging people are paying tax for. And of course, you have tax credits down there too, right? Income tax credits. We call them ITCs up here. I'm not sure if it's universal or not.
That's complicated. And
I know. I've actually watched someone work through the formulas. I'm sitting there going, I can't follow this rabbit going down. And that's one of the reasons why that's not my niche. And I got that. You hire someone to do that. But when you build out a budget, you can map out and you get a sense of, are you on target or things are shifting? A price of a product goes up that you're using, or there's more demand. Do you help a client build out their budget?
Absolutely. And the thing is, the two things we really do work with a lot are budgets and forecast. And a lot of people don't know the difference between those because they are very similar.
I saw him jumping up and down. He's wanted back in.
That's Ripley. She's 1 year old. So she is just a big, lovable dog, but still full of energy. Go back to the budget. So yeah, we definitely help with that. The budgeting and forecasting are the two big things that we work with. And a lot of people feel like they're very similar, but it's important to understand that a budget is more static. We set that up and we'll adjust it periodically, but it's not a living document. This is what we think we should do. And we can set it up by percentages, amounts, or historical data, whatever it takes to set up that budget. Then we have a forecast, which will start with that budget, but we'll look at it month to month and say, okay, this month we think this is going to change, and we'll adjust month to compared to our budget, compared to our historical data, compared to sales we know that are coming in, compared to expenses we know that are coming up. And by the end of the first year of working with a client, that forecast can lead into our next year's budget and really helps us influence what we're setting up. And it's just one of those things with a budget, you're really basically setting a target for yourself. And I think, as anyone knows, if you're an archer and you don't have a target to shoot at, what are you shooting at?
One thing that surprises people that know me, but that's beside the point. I was always amazed that 30 years ago, a year end was fundamentally a dead document, and the owner didn't have a clue. How have you managed to convince them that an accounting professional should actually be a CFO, that it actually helps you run your business rather than just do compliance accounting?
Okay, perfect. I love this question because I'm not as familiar with the systems up there, but in the US,
it's identical.
The thing I look at from our system is you really should have, at bare minimum, 3 professionals in your finance division. Now, of course, depending on your ability to cover that and your experience and what your professionals can do, I suggest that you have a CPA, a bookkeeper, and a CFO. And they're all 3 different.
Okay.
Now, in our case, like our company, we do CFO work and bookkeeping work because we do like to know, as a CFO, you're only as good as the data you're fed. So we like to do the bookkeeping as well so that we know that the data is accurate. And your your bookkeeper is about tracking the data, tracking transactions, and making sure everything is correct. Your CFO is more forward looking. They're more planning for forward activity, budgeting, forecasting, helping you make adjustments to increase profitability, to grow the company, whatever your goals are. We're working towards those goals. And your CPA is more focused on taxes and making sure the government gets what they're supposed to get and that you don't get audited, or if you do, you get covered. That all of the things in that nature. It's more backwards looking. So it's an important delineation, because I find a lot of clients, when you ask if they've got an accountant, they'll say, yeah, I've got a CPA to do my taxes. Do you have a bookkeeper? I send my CPA everything at the end of the year. No, that's not your bookkeeper. Your CPA hates you. Our firm does not do taxes at this point. We are considering bringing on a CPA service all three areas. But at the current point, we don't deal with taxes other than very high level. We will always tell you to go consult your CPA if we are worried about a tax problem. I have some general knowledge about taxes, enough to get me in trouble. And so I very clearly do not advise on tax policy. But we are there about growing the business and seeing what we can do to increase profitability, put more money in your pocket, and to reach those goals, whatever they may be, whether you want to grow the business and sell it, whether you want to just have a business that's out there making passive income for you, or if you're more of the self-employed type that's just, hey, I created a job for myself and I'm going to keep plugging away at this and maybe build up some retirement until it's time to go.
I actually want to be bold. One thing that I would find, hire that CPA, and I'll tell you why. The client gets lost listening to more than one professional. If it's the same guy with the same script, it's much easier for the client to know who to call.
I agree with you. And it is a thing that we're actively looking and just working to. We work with a few CPAs directly that we have good relationships with, that we share clients with. That works very well, as long as we understand what that CPA is looking for from the bookkeeping side of things. The other thing I found is that if we give a set of books to 10 different CPAs, we're going to get 10 different answers of why we're idiots. To know that specific CPA and to know what they're looking for and to tailor the books not only to the client, but to the CPA is a very important part of the bookkeeping process. But then to also know from the CFO side of things, how do we move these books forward? How do we take this data and use it as actionable advice to go forward and to grow the business?
I knew of one CPA firm that was also had a restaurant division. They specialized on cooking the books.
Have fun. Have fun.
Well, you'd fit right in on my firm. We're all about bad jokes.
He is a dad, though, so that's probably where it's
yeah.
coming from. If you're looking at someone and they're coming on board, you're just trying to get them lined up into a good pattern of behavior. What's one thing you would like to relate to a business to say, hey, you do this on a regular basis, it'll keep you in good stead, it'll point you in the right direction. It's not a complete answer, but what's the root element that they can do to stay on course?
You mean aside from hire us?
You know what? Resources, you're right. If you've incorporated, that means there's a lawyer involved typically. Some people do it ad hoc, but if you have shareholders, does that get complicated? Share stocks, and yeah, that's a whole nother box, right?
For one thing, I see a lot of people, and it's a great sign that you need to hire out for a service. When you are really putting something off or don't want to do it, it's probably a good idea to get someone else to do that for you, because it's taking up time, energy, and is probably not something you're great at. So there comes a time in businesses from a financial standpoint, if you hate doing your books, or if you're just not doing them, if your CPA hates you, it's a time. I had a call with somebody very recently. He said, my CPA has demanded I get somebody to do my books for me. If you're somebody who really hates doing your books or hates looking at your numbers, or you start looking at them and thinking, God, this is scary, it's time to hand it off to somebody who knows what they're doing. and let them take care of it. People like us, we're not scared of the numbers. We love the numbers. That's what we do. You put marketing in front of me and I bury my head in the sand because it's just not what I do. It's important for a business owner to understand when it's time to bring someone else in, a third party that's not emotionally involved, that can look at your set of books and be tough with you if we need to be, and say, hey, you need to stop this, and fight the emotional arguments of, yeah, but I really love this software. Yeah, but you have 4 others that are doing the same thing and you're paying thousands of dollars for it. Stop that. Or we need to generate more revenue, so we're putting more into marketing. You're putting too much into marketing. Cut it out. Let's adjust prices and figure things out.
Matt, one thing I'd like to ask from what I've seen is, do you often advise people to hire themselves, to actually put themselves on a salary so they can decide how to afford their lives and let the business profitability take care of itself?
That really does depend on the client. And that's one of those things that I tend to bring a CPA in on the conversation. The first thing we would want to look at is, if you're a solopreneur or a small business owner, you have these personal expenses. You have your house, your children, everything that your normal life requires you to spend on. If you don't understand what you need to survive, how do you know what to pay yourself? So we want to look at, from the business, what do you need personally to survive? How much do you need to pull out of the business? And what are the tax implications of that? So that's why I like to bring a CPA into those conversations and say, okay, you need to make $5,000 a month personally. We're going to have to pull this out of your business somehow. Are we going to do it through a W-2 status? Or it depends on your corporate structuring. Are you an S Corp? Should you take owner draws? Are those owner draws going to put you in tax problems because your business is insolvent? Well, there's many different layers of that. And unfortunately, that's not one of those things that we can go, hey, if you're an S Corp, take owner draws. And if you're a C Corp, give yourself a W-2. Who knows? Without really looking at the books specifically.
Actually, the nice thing in podcasting, they say, we do not give legal advice. Call your
Right.
professional.
Exactly. I'm very careful not to give tax advice.
So at the end of the day, when someone is, let's say they're just starting their business up or they are up and running, how long does it take them to get squared away from the bookkeeping side of it? Is it like a one-day process? If they've been in business for a while and they have a shoebox, another problem, right? The shoebox
Right.
receipts, right? Everything's in one jumble. How long does that normally take to either ramp up or
On a startup basis, someone who's just starting, I highly suggest starting your books right away. Even if you're a small startup and you can't afford to hire someone, just go get a QuickBooks or a Xero account. I'm a bigger fan of Xero. I think it's much more user-friendly. Any sort of accounting software like that is a good starting point. Get to know it a little bit. If it's overwhelming, you can find a relatively inexpensive bookkeeper. They're going to be able to set you up, get you going, get your chart of accounts built out, get your bank feeds going, and start you down a correct path. Now, as your business grows, that particular bookkeeper is probably, your starting bookkeeper is not going to necessarily be the one that stays with you for the course of your business. And that there's different specialties. And in the beginning, the starting bookkeepers are not going to be great about walking you through your profit, your income statements or your balance sheets or cash flow statements, but they'll be able to put them together and send them to you. Once you reach a point, my general rule of thumb is your accounting in general, those 3 pieces that I say, the CPA, the CFO, and the bookkeeper, those 3 pieces should account for 1 to 3% of your gross profit. And once you've reached a gross profit point, below that number, it's probably time to upgrade. It's time to bring in a better bookkeeper and a CFO and make sure your accountant's in line. Getting books in order right from the beginning is super important. And it's one of the things a lot of business owners just don't do. Hey, I'm going to sell paintings online, whatever. I'm a painter and that's all I know. The money is handled by the bank. That's not good because the bank doesn't care about you. But those can be set up in a few hours. Any decent bookkeeper can set up your books from scratch in no time, really. and get all that together 2-3 hours, maybe if you're brand new. The difficulty starts happening when we get into a very established business. And when you've been around for 2 or 3 years, making $1 million plus a year in gross revenue, and you don't have anybody doing your books except you're on a little spreadsheet, or you've been doing it yourself as somebody who's not specialized in it. Now we have a cleanup process, and that can vary depending on how far we go back. Somewhere, especially for us, earlier in the year, the better, because typically we're in March when you post this. We're in whatever month and need to go back to the beginning of the year. There is some expense and time involved in doing that. For our established businesses that we take over, I really like to set a expectation of about 3 months before we really have the books back in line, before we really understand your business, before we really have cleaned up everything inside the books and put them in proper categories and found all of your accounts receivable, all of your accounts payable, locked those down, and that's just a general rule of thumb. I've had some of those that have taken 2 months. I've had some of those that have taken 5. It just depends on what a mess it is. Even sometimes we have to step on some toes with that and then say, yeah, this is good effort, but not where you need to be.
Matt, it's been a blast chatting with you and making you laugh. What area do you like to serve? We're on Zoom, so technically you could do books in Norway. But what area do you like to serve, and how do we reach you?
I am US based, so we do anywhere in the United States. I don't step over the line to Canada yet. I'm a little shy of the laws and any changes over there that I wouldn't understand. We don't want to take a risk with our clients if we're not secure in doing it. We work mostly with e-commerce businesses and real estate investors. Realtors or anyone in that real estate industry is really a big place for us. To reach us, our website, gainescapitalbooks.com. That's GAINESCAPITALBOOKS.com.
So, Matt, I understand you have a cash flow assessment quiz to work with. What's that all about? What should people know and understand about it?
Yeah, it's very simple. You just go in and take the quiz. It's generic questions, nothing getting too specific, but more about how are you handling your cash flow? Is it under control? At the end of it, we'll give you some advice, some free resources. If you're in a really good situation and you just need some direction, we have some deals on some discounts on talking with us or any kind of resources that we can provide. And it's just a very simple thing to go through and do, and no obligation. Just hop on, toss in your email address, and go through the process.
Thank you to Matt Partrich, my co-host Wayne Pratt, and you, the Knack for Business listeners. Hopefully you found understanding the bookkeeping and the fractional CFO purposes if you happen to be in the U.S. and you need that sound advice, managing your books, and also, are you actually making money or are you doing more but losing money? Reach out to Matt.
To reach the podcast hosts, email them at info@creativeinsight.com or by the website creativeinsight.com, spelled KREATIVINSIGHT.com. To reach Wayne at his email, wayne@motivateyou.ca, that is MOTIVE, the numeral 8 and the letter u.ca, or his website, motivateyou.ca. If you would like to be a guest on this podcast and share your knowledge, let us know. We would also appreciate your feedback on the content or format. Check the show notes for more details. For these podcasts, we like to acknowledge the support and thanks to the following people. Carl Richards from Podcast Solutions Made Simple, a renowned podcast expert. Fred Crouch, who is the Property Wizard podcaster, where Bernie is a co-host. Jovan Strika from At Hive, a co-working space that is more than just a space. Then Melanie Weber, Bernie's invaluable business partner, and Wayne Pratt from Motivate You Inc., who serves as both a coach and co-host of these podcasts. Disclaimer: please note that the Knack for Business podcast episodes are meant solely for educational and general informational purposes. The information and opinions contained within are not intended to be professional advice on any subject matter. The The thoughts, views, and opinions expressed by the participants are their own personal beliefs and do not represent the views of the podcast hosts or any affiliated organizations. It is important to note that this podcast is not a replacement for consulting with certified experts in your area who possess knowledge of your unique situation. The hosts of the podcast, along with any participants or affiliated groups, do not take responsibility for any actions taken or not taken based on the information presented in this episode. It is highly recommended that individuals seek guidance from their own personal advisors in fields such as accounting, law, or other pertinent areas prior to undertaking any actions or making decisions that may impact their financial, legal, or other aspects of life.